Hello everybody. Guess what season it is? It's not the holiday season anymore, it's tax season. So who does your taxes for you? Do you do it yourself? Or do you have one of the big box stores that do it for you? Do they have your best interest in mind? Do you think that they're maybe too conservative, that you should be getting more money back? Well, today, coming back is Cathi, Korelin, our tax guruette. And she is going to share with us what she does and what to look out for. And she is here to help you out in this process next on the Small Business Voice. Hello everybody. Thank you for watching the Small Business Voice. The Small Business Voice is a platform for small business owners to have their voices heard. And what would those voices ask you to do? They would ask you to be loyal and please buy local. So today, Cathi Korelin, our tax guruette, is back here visiting. She was here last October talking about insurance. So today she's going to talk about the upcoming tax season. And Cathi, thanks for coming on the show today.
Thank you for having me.
All right, thanks for coming back, actually, I should say.
It was fun last time. So
yes, it was. It was a lot of fun. We have a lot of fun here on this show. We try to keep things light. We cover serious topics, but we do try to have fun. Mm-hmm. So we're in tax season. It's January. So, and we have new tax laws that are coming out that we have to deal with for the first time. So, I want to cover, how it affects business owners, how it covers individuals, maybe people that are divorced, So let's start with individual. We'll start with the single people. So you're here to talk about taxes. Mm-hmm. What are some of the new laws right now?
So we've had a change in a couple of the existing laws that people have seen for a long time. And one of the biggest things that people are looking at is the stamp deduction has nearly doubled and the exemptions have gone away. But what does that mean? So we add your stamp deduction and your exemption together, and that's how much you can earn before you have to pay any taxes. So for an adult, that has been $6,300 for your stamp deduction for a while.
Okay.
If you're married, head of household is higher.
Okay. Your
exemption has been $4,050. Add those together, the first $10,350 you make is not taxed. So you have another adult, you're married, it's $6,300 times 2. For yourself and for each child, it's been an additional $4,050. So what has happened with the new tax laws is this $4,050 is gone. Mm-hmm. But the $6,300 has doubled to $12,000. So that makes up for it. If you think about $10,350, it's still lower than $12,000. So for the single person who's not itemized everything, they're actually going to be in a little bit better position. They're actually going to save a little bit of money. Okay. So that's nice.
That is nice. So a lot of people, I've heard a lot of criticism on these new tax laws, but I think people are kind of overreacting, would you say, a little bit?
It depends on where you fit in the income scale. So if you had children and this $4,000 per person is gone, and you had 1, 2, 3 children that are 16 or under, that $4,000 per person you've lost means that's more income that's actually taxable to you. Okay. But the child tax credit has doubled from $1,000 to $2,000. So what that really means when you add those together, if your income goes up by $4,000, if you're in the 10% tax bracket, that means your taxes only went up 10 times $4,000, which is only $400. Okay. If you're in a 25% tax bracket, your taxes went up 25% times $4,000, so $1,000. So it's not the whole fourth, so it doesn't sound quite as scary as losing $4,000. Mm-hmm. The child tax credit has doubled, so if it went up $400 and you get the extra $1,000 child tax credit, you're actually ahead by $600. Okay. If it was $1,000 in tax and went up, and you get the extra $1,000 child tax credit, well then you've broken even. The people who are going to be seeing it on the negative side, we're going to be if that child was 17 or older, mm-hmm. and they didn't have a tax credit anyway. The child tax credit has been gone for that child, and that's not a change. But now you've lost that exemption for that child also.
Okay.
So you're going to have $4,000 more of taxable income with no credit to offset it.
Okay. So let's talk about the child tax credit for a second. So as a parent, I can have my kids on my insurance till they're, I think, 25 or 26, something like that. So they can live at home, they can be on my insurance. They're still dependent, but not in the eyes of the feds, correct?
So it depends, yes. If somebody is living at home, if they're a full-time student, under 24, and they don't provide more than half of their own support, they generally qualify as a dependent.
Okay.
If they're 26 and living at home, and they're not a student, then whether they're going to be a dependent or not depends on if they're working and creating an income.
If you have somebody that's 26 being at home and they're not going to school, there might be a problem there, huh?
There might be. But again, the only thing they were worth was that exemption, and the exemption is gone. So they don't have any benefit for you to be as a dependent on your taxes.
Well, and also, too, the thing with California is the cost of living is going up and up. I think I saw a report that it takes 3 people to support a household now. So for the people that are just starting out, you have to cram 5 people into a studio apartment, it seems like, to make a living, and even things should still be kind of tight in more ways than one. But let's go into how does the new tax laws affect married people? Because you have the combined incomes.
Certainly. Well, when you're married, you get 2 standard deductions. So now it's going to be 12,000 times 2, which is 24,000. Where it makes a difference is you have a choice of deducting your standard deduction, which a lot of people choose, or itemizing. And itemizing is when you have your mortgage interest if you own a house, the property taxes, and all those other small deductions, the charitable deductions. You have a choice of which one you want to take. Now that the standard deduction is nearly doubled, fewer people are going to be needing those itemized deductions because the 24,000 if you're married is a lot higher. If your standard deduction before was 6,300 and you had 9,000 itemized or 10,000, it was a good deal for you. Now that it's 12,000, you won't need to take care of all that paperwork for federal. Now, California has not changed their laws. So, in order to keep the rules simple, like we were promised when we had new tax laws, California, you can still do that itemizing.
Okay.
So all those paperwork that you were saving before, that you were told, oh, you don't need that now because standard deduction is so much higher, we can still use on California. So now things are actually more difficult than they were before. Okay,
so what you're saying is, I drive truck at night. This is not my full-time job. People out there are probably saying this, but that makes sense. So I drive truck at night. So in the past, I've had to buy, flashlights, batteries, work shoes, headsets. There's a lot of things that go into being a truck driver. You just don't get behind the wheel and drive. There's a lot of things that you have to do. Now we were told with these new tax laws that we weren't be able to write off our expenses anymore. Now, what people don't know is you can't write that off with the federal now, but you can still write those off with the state, correct?
It should be that way, yes. So any employee that would put money out of their own pocket, they used to include those in their itemized expenses. Okay. So a lot of people who work for other companies like lenders, they might have a lot of marketing and advertising expenses. Truckers have all those things you listed, and if they're truckers that drive long haul over cross country, they had a per diem, which they can deduct for every night they were out. Yeah. That could be $1,000. All that is gone for employees. If you're an employee, you can no longer deduct any business expenses whatsoever. They have completely erased that whole part of the tax return.
Okay, but the feds, correct?
Correct.
Okay.
Now, don't get me wrong. If you're self-employed, those deductions are still there. People are getting them confused. So if you're an employee, there are no more deductions. But if you're self-employed, those same deductions are still there.
Okay. So with the with the employee, though, can you still write off those expenses with the state?
Anything that we can itemize from federal, we should still be able to itemize for California.
Okay.
So that's good.
Okay. So basically what we're saying, just keep your receipts just in case. You know, you never know. You know, it's now there's different programs, like an employer can offer their employee that's buying their own equipment or whatnot, you know,
exactly.
Accessories. And it's a win. You were saying it was a win-win. It's, you know, the employee can still get reimbursed for it, and then the company can write it off.
Right. There are accountable reimbursement plans out there, and many companies already have them. Like if you go and do errands for the company, they reimburse you for the gas.
Okay.
So those programs are out there, and they can be used for all those expenses, those flashlights, all the things the truckers need. If you're paying for your own marketing or advertising, all those things could be paid for or reimbursed to you by the employer. And if it's on an accountable reimbursement plan, that money that they give you to reimburse those expenses comes to you tax-free, which is a nice little check there. And then it's a deduction for the employer.
Okay.
Not every employer wants to put out the money for that. That's why you're paying for it on your own to start with.
Yeah.
But at least it is a deductible expense for the business.
Okay. Why wouldn't a business not have that plan? Because it sounds like a win-win, but is there a lot of paperwork involved? Is there extra steps?
There's going to be a little bit more paperwork for the company. They're going to have an HR person that administers the program.
Okay.
Most companies have them already for smaller things.
Okay.
And with the new Trump's new tax laws, corporations, their tax rates were lowered down to 21%.
Okay.
So some corporations were paying 35, 40+% in taxes. So now it's gone down to 21%. That money that they're saving in taxes, a lot of companies are now putting into their employee programs. Okay. So there's more money to allocate to help pay those expenses.
Okay. When you were talking about like the advertisement, so I see a lot of advertisement for realtors across town. They're on like the benches, the bus stop benches. They're on, some of them are on buses, and you see them all over the place. Now, are they a small business owner or are they employed? And if they're both, can they write it off anyway?
Well, realtors basically by definition are self-employed.
Okay.
The Business and Professions Code actually makes them self-employed, so they can still write all those expenses.
So they're strictly commissioned. They're not getting a salary, basically.
That's how most work.
Yes.
There could be some that work different, but they can still be employed. They can still be self-employed even if they're on a commission or non-commission basis. Okay.
All right. So you have some testimonials you want to talk about next segment?
Absolutely.
All right. We're going to take a break. We'll be right back from a word from our sponsors. Welcome back, everybody. We're back. We're sitting down with the tax guruette, Cathi Korelin. I wanted to talk to you about a testimonial you have. Now, you had a married couple, just got married. They were both, I think you said they're both business owners. I could be wrong on that. But they made quite a bit of money. Then they were doing their taxes, or he was doing his taxes himself, and kind of got into problems, a little bit of trouble a little bit. You saved the day, correct?
Yeah, so I had a couple that got married. Okay. They were each making around $80,000 a year each. So you add that up, that's a lot more money. $160,000 puts you into a new tax bracket. I told them before they got married, bring your information so I can look at it, and let's proactively fix any issues so you didn't have to owe as much money maybe at the end of the year, or owe any money.
Yeah.
So he did his own taxes. He he did everything he was told he was supposed to do in life. He funded his 401ks, his IRAs. He had educational accounts for his kids. Mm-hmm. He did everything he was supposed to do. So he did his taxes. He put all the information into the software, and he had no deductions. Everything he had, it showed he had all this income, none of his IRA contributions, none of his education credits. Nothing showed up on his tax return. Between federal and state, it showed that he owed $27,000.
Wow, that's a lot of money. Doesn't matter if you're making $160,000. That's a lot of money. But you were able to save the day. So he was doing his own taxes.
He was doing his own taxes.
Okay.
Yes,
and
using a popular software.
it's not recommended. I've always gone to somebody for my taxes. I don't feel comfortable doing my own taxes. That's just me. So, especially with the new tax laws coming out, you suggest see somebody this first year, that the new tax laws are in effect, so you can kind of stay out of trouble. So, getting back to that story, what did you do to help this couple out?
So what he had done was he had a child in college, and he had taken money from the education account, and because he did not put it in right, it added to his income. So he had the $160,000 as income. He had the distribution from the education account as income, and the scholarship information from his son was all counted as income. So what happened was they had so much income on their tax return that it phased out all his other deductions. Deductions only good depending on how much money you make. So his income got so high that all the deductions went away.
Okay.
So what I did was I went in and I reallocated the money. So this money was supposed to go to room and board for his son at school. This money is supposed to go to tuition. And when we made those allocations, we put some of the scholarship income. If your scholarships are more than the tuition, the rest is the difference is taxable. So we moved that to the taxable part to the son's tax return. Okay. So now it wasn't that much. The son doesn't pay any taxes on it.
Yeah.
And now mom and dad don't have to pay any taxes on it.
Mom and dad are happy now.
we got their income back down to just their W-2 income, what they made from their jobs. Okay. And now all of a sudden they had a $13,000 deduction for the IRAs. They had their American Opportunity Credit, and by reducing all that income, they now owed $5,000 between federal and state. So we brought it down from $27,000 down to $5,000.
Wow, that's amazing. You're saving a lot of money right there.
Yes.
Yeah, and a lot of headache too. And I don't think what people realize is, tax season comes along. It's a big headache for some people. Mm-hmm. So we have new tax laws coming into effect. How are these tax laws going to affect? We'll start with businesses, and I want to go into direct sales and multi-level marketing. So traditional businesses, how do the new tax laws come into, or how do they affect the small businesses and other businesses?
The biggest effect for businesses this year are twofold. One, the maximum corporate tax rate is now 21%. So if you were a personal service corporation before, you had a mandatory 35% tax rate. Okay. So now corporations are down to 21%. Okay. But what happened is if you're a small corporation, your tax rate was already under 21%. So you're getting a little bit of a tax hike. Okay. So what they've done is they've given us this new deduction, and it's called a Section 199A, or what we call a QBID, a QBID. And what it is, and of course there's a lot of qualifications, ifs, ands, or buts. 20% of your qualified income, which is basically your profit, compared to 20% of your taxable income, whichever is lower, is actually a deduction off your income. It's not a deduction off your taxable income from your business, so you still pay the same Social Security and Medicare taxes. Mm-hmm. But if you make $150,000 a year, how much is 20% of that? That's a huge deduction. Yeah. If you're married and you make, one of the phase outs is $315,000, 20% times $300,000, and that's a huge amount of savings right off your income. Mm-hmm. So that's a big deduction for business owners, as long as it's not a C corporation. It works for what they call a flow-through business. Flow-through is anything that goes to your tax return. C corporation does their own taxes. Okay. So I hear a lot of, I've been involved in different multi-level marketing businesses before. So they promoted it as you're buying, your own franchise. You're getting into the business for anywhere from $100 to $500 usually, maybe $1,000, depending on what business it is. And it's a home-based business. How the new tax laws, or do they affect, people that are doing multi-level marketing, direct sales? How does it affect them as far as maybe they're not making a lot of money doing it, or maybe they're making, 7 figures doing it? How does it affect somebody that's doing that? Well, they're going to actually get the same deductions as anybody else because they are a business. Okay. So whatever they have that profit, they can have that 20% off their profit. They're probably not going to have most of them are not going to have the same earnings as a larger business. So if they have a $2,000, $4,000, $5,000 profit, 20% isn't going to be as much, but they still have it. One of the recent changes also has been an office in your house.
Okay.
So we've always taken, how big is your office, how big is your house, what are all your expenses. Some people get a little nervous because it's always been considered a big audit trigger. Some people won't take it. I figure if it's valid, then we're going to take the heck out of it.
Yeah.
But they have what they call a safe harbor deduction now for that.
Okay.
Which is only good for up to like 300 square feet, $5 a square foot. So it's a deduction, but it's a safe harbor, so you won't get audited on that deduction. So if you deserve it, but you're not sure you want to take it, you can take the safe harbor and not have to worry about it being an audit trigger. Though if it's a valid deduction, I would rather you take the higher amount that's available to you.
Okay. All right. So a valid deduction would be somebody that's, you like in their living room working on, they have their desk in there or a private room, or some people have property so big they could build an office somewhere, and then that'd be a valid.
So a valid space doesn't have to be large.
Okay.
It can be a corner of a room, but it has to be used regularly and exclusively for the business.
Okay.
So if you have an office in the guest room and people sleep in there when they come visit, you can't count that as a home office.
Okay.
But if you have a desk in the corner of your living room and you just use that space, that counts.
Okay.
If you're selling stuff and you have your inventory in a closet, that closet space counts.
Okay.
So it just has to be, space exclusively for the business.
That's a good question to ask you. When people come to see you prepare their taxes, that's a good question to ask. It's, the clarity on it, I'd rather people know, and not guess. But I like the safe harbor one too, because you can kind of use that and then just peace of mind. So.
Well, this is where it matters how things fit together.
Yeah.
Taxes to me are a big puzzle. So when you're deducting your home office expense, you're deducting a portion of your mortgage interest, a portion of your property taxes, a portion of your utilities. But let's say you actually qualify to itemize also. If you it's going to be your itemizing is going to be higher than that new standard deduction. Well, we don't want to put that itemizing part of that mortgage interest on the home office because that makes your itemized expenses lower.
Yeah.
So then it might be a better idea to take the safe harbor and keep all your home mortgage on your itemized expenses.
Okay.
So this is where the popular softwares don't ask you these questions. Do you want to prepare for these? And this is a good reason why it's a good idea to see your tax professional during the year.
Yes.
If you have any life changes, you need to know how those affect your life every day.
Okay. So we covered a lot. Why don't we go ahead and take a short break? We'll be back from a word from our sponsors.
Every journey begins with a single step. Are you ready to take yours? Here at Modesto Junior College, we can help you begin. The college offers a variety of programs and opportunities, including financial aid. MJC students can transfer to four-year colleges after graduating. Our instructors will prepare you for a successful future in the field of your choice. If you want a quality, affordable education with unlimited horizons, make Modesto Junior College your first step.
Hello, we are back with the tax guruette, Cathi Korelin. Cathi, I want to ask one last question. What if you're an individual or business that gets that dreaded audit? People kind of freak out when they see that. Is that something to worry about? What happens during an audit? And how can you help them?
So, if you get a letter from the IRS or the state, the first thing you want to do is to call your tax professional. Well, the last thing you want to do, and this is the most popular thing, is to throw in the trash. Some people don't come and see me until they've received 3 or 4 letters.
Okay.
By then, we have deadlines and you may have missed opportunities on things you can actually do. So I'm an enrolled agent, which means that I'm a federally licensed tax professional. And I can assist you with any matters between the feds or the state. So you actually have a Bill of Rights. There is a tax preparer Bill of Rights. Number 8 is the right to representation.
Okay.
And that's where I come in. So I mentioned before that I actually wanted to be a tax lawyer growing up.
Yeah.
This is a way that kind of fulfills that dream because I can actually represent you. And now in November, I'm actually planning to go to Washington, D.C. to take the tax court bar exam.
Oh, okay.
And if I pass that, I actually can represent you in tax court.
Nice.
So if you do get one of those letters, you want to come and see your tax professional quickly because every letter has a deadline. And there are deadlines that you can miss. You can miss an opportunity to go to have with an auditor. You might miss an opportunity to file to go to tax court if you have a really serious situation. So I had a gentleman that came in and his student loan was discharged. And they wanted $8,700 in additional taxes because of the student loan.
Yeah.
And he was like, where am I going to get $8,700? And we were actually able to make him insolvent and get it down to 0.
Wow. So, if you ever get that dreaded letter, contact your tax professional. And there's a lot of scams out there right now. Like you might get phone calls from the IRS. You might get letters that look pretty, real. And since there's a lot of scams out there, it's always a good idea to just contact your tax professional first.
Absolutely. The letters look like they came from the IRS. And there are emails out there now also that look like they came from the IRS. And they look official. They have real codes and real names and numbers on them. The IRS will never, ever call you to start any type of procedure. Never. If you get a call saying you owe money, they want the money on a debit card, they want money now, or they're going to send the police out to you, that is never, ever true. Those are always scams. Okay. And IRS always gives you a 30-day letter. It's always going to be a letter coming to you. So if any type of call, just ignore it. Just get through it, hang up on them, just ignore it.
And email for that matter.
And
too.
Emails, yes. They have very real looking emails. Do not click on any type of links whatsoever in any emails that look like they're from the IRS.
Yeah. So you'll get a letter from, if you're really being audited or being contacted, there's going to be a letter and saying, you have 30 days to contact them. And like we said, it's best that you have a tax professional, especially this first year with the new taxes. It's good to have somebody in your corner, like the tax guruette, Cathi Korelin. So, Cathi, I just want to thank you again for coming on the show today.
Thank you.
Yeah, you're my first guest that's come on twice. So, thanks again for coming on. Now, if you're a small business that wants to have their voice heard, please contact me at newsmallbusinessvoice@gmail.com, or you go to our website, smallbusinessvoice.biz. And we also have a Facebook page now, Small Business Voice on Facebook. You can like us there, and you can see some of the past shows that we've done. So again, Cathi, thanks for coming on the show. Thank you for watching the Small Business Voice. Join the crusade! Buy local. We'll see you next time.